Good morning, and I'm Mark Spurns from Spheria Asset Management, and I'm here today to talk to you about growing and preserving capital during risky times. What I want people to take away from this presentation today is that the stock market can be irrational short term, but in the long run, we think the market is actually very rational. And the main benefit for you to understand this is to avoid getting sucked into sort of short-term stories and look through and provide fundamentals, which we think will lead to long-term outperformance. So to frame today's conversation, I'm going to go through a quick agenda. So first of all, I'm going to talk about why the market short-term can experience bouts of irrationality and what might drive these kind of things. Stories are exciting for investors, disruptive models, etc., sound like a very good place to put your money. And of course, when rates are very, very low, there's very little else. There's nowhere else to put your money. You can't get yield on bonds. You can't get yield in the cash in the bank. And so the market tends to rush back into the stocks to try and get return. Secondly, I'm going to go through and suggest what a good long-term model might be and what it might look like. And no surprises, it will involve cash flow. And then finally, we'll go through and explain and show and demonstrate how this over time does in fact provide a very good long-term model for investors, where you can compound your wealth at higher rates of return with in fact lower risk. So in the short run, I want to reintroduce or resurrect a model I discussed about a year ago on a similar sort of presentation with Pinnacle. And that is really this analogy of the market being like the Matrix. You might recall The Matrix was a film originally shot in Sydney around 1999 with a lead character, Neo, who was plugged into the Matrix at the time. And the main character, Morpheus, offered investors the choice between a red pill and a blue pill. Not investors, offered people the choice between a red pill and a blue pill. You could either take the blue pill and remain effectively plugged into this sort of machine-led world, or you could take the red pill and see the truth and actually see what was going on in the real world around you. And if you go back sort of 12, 18 months, the market had this real fixation with incredibly low interest rates. There was this belief, what I call IZERP, or infinite zero rate policy. That everyone thought that central banks would remain all powerful, they'd keep buying bonds forever, and that would keep interest rates incredibly low. That provided abundant liquidity for investors in the stock market broadly. And really, there's a lot of what I call blue pill thinking. The market was very plugged into hot stories, hot ideas, momentum, and very little was focused on fundamentals. As rates have started to rise in the last 6 months, we've seen the cost of capital rising. We've seen risk off. People's appetite has changed. The idea that inflation is transitory is sort of receding in the background, and valuations become a bit of a thing again. People are starting to think about what am I buying here? What are the alternatives to my cash? Rising rates mean that cash burning companies are actually becoming more costly to hold. So there's a bit of questioning around, is cash flow worth more tomorrow or worth more today? And with rising rates, it does tend to lead people back to the idea that cash is actually worth more today than tomorrow. Put that in context, what did blue pill thinking look like? Well, we talked about short term and momentum and what can happen to investors' approach when people get very carried away by liquidity, for example. And the market goes through these incredible mood swings where you become very exhilarated by certain ideas and certain stories. Disruptive stocks, fintech and biotech were all very exciting, especially in smalls and micros. And people tend to get onto stories that sounded very compelling. There wasn't much red pill thinking going on. It was all very much what's the narrative of management teams, how big could this market be in 5 years' time? Very little application around what the business was today, what cash flow was today. And as I said, there's nowhere else to invest. People were kind of crowded back in the market because there's nowhere else to get yield on your returns. And so the market went what I call sort of upside down for a period of time. It actually inverted. With rates being very, very low, people chased hyperbolic returns. And what you see on the right here is a graph that we put together just summarizing the small companies universe, so stocks between 50 million and 3 billion, so that includes micros and smalls, and just said, okay, what would have happened if you just literally bought a portfolio, equally weighted, of stocks that had negative operating cash flow at the beginning from September of 2019, where rates really hit the bottom. And you can see that perversely, and I've got the blue line there being the blue pill, but negative operating cash flow companies materially outperformed positive operating cash flow companies on average over that period of time. However, you can see that towards the end of that period, that curve does come down. And so the negative cash flow operating companies did start to pull back towards the end of that period, obviously with rates starting to tick up. And I want to propose to you a better long-term model, one that we think will provide better long-term returns through market cycles. So what would red pill thinking look like to investors? I mean, if we did apply something that was slightly long-term, how would that look, and why do we think it's a really good idea? Firstly, red pill could look like central banks exiting buying bonds long-term. The idea that capital is free, and excessive use of ETFs would abate, and people would start to think about capital allocation more rationally. And so would management teams. For a long period of time, capital's been very cheap to raise money, and the way capital has been allocated by both companies themselves and investors has perhaps been a little bit loose. So with rates rising and a longer-term lens being applied to the stock market, we think investors will question this idea that growth at all costs is where you should put your money. We think you'll see rotation out of sales growth companies with questionable business models, and back into things that look a little more fundamental. The IPO market could well slow down, and cash-rich stocks with valuation support are likely to outperform in that kind of environment. So what I'm proposing in summary is that cash flow and valuation are likely to lead to long-term outperformance, and we're starting to see that rotation at the moment in the marketplace. Now, how does that look if we backtest that? I said to you originally at the beginning, the agenda would go through and show you how that would actually pan out in a long-run scenario. And this chart here is one I've presented to investors before, and what it does is it seeks to, it uses Bloomberg to backtest a theoretical portfolio over time, and it looks at the market over 20 years and says, okay, if we had just bought a portfolio of companies with positive operating cash flow and rebalanced it every single month, equally weighted stocks, how would that have performed over a long period of time when the market's got time to sift through and weigh fundamentals? And you can see from that red line there, what I call the red pill thinking idea, is led to dramatic outperformance. So over a 20-year period of time, in theory, obviously this model doesn't include transaction costs, so it's a bit of a theoretical back look at what would have happened if you bought these companies, but you would have compounded your wealth 13.8%. The dark blue line in the middle there is the Small Ordinaries Index, which is giving you around 7.5%. And then if you only invested in stocks that had negative operating cash flow and you just rotated the portfolio every month to make sure that you only owned the negative operating cash flow companies, you end up with the blue line at the bottom there, what I call the blue pill thinking line, which is a compound return of about 0.3%. So, dramatically underperformed, cash flow companies and in fact the market on average itself. So just to put a light in the package and explain how we at Spheria operate and think as a team, we've always had this focus in smaller micro caps on what we call sustainable free cash flow. And we look at numbers through the cycle. So many stocks go through gyrations. There's cycles and everything from resource names through to even tech stocks have their own cycles. And we like the idea of trying to smooth out aggressively over-earning companies, or equally not punish companies that are temporarily under-earning what they can do on a long-term basis. So we look at a through-the-cycle cash flow. Secondly, we like to buy stocks that are lowly geared. And why is that? Obviously, with rates being very low, it's tempting to buy stocks with high debt levels. Who maybe have geared up the balance sheet to get earnings accretive deals, etc. But obviously, with rates rising, that will increase the cost of debt and start to put pressure on the earnings of these companies with massive amounts of debt in the balance sheet. And then finally, we are trying to buy stocks at a discounted valuation. So we try to value the stock on a mid-cycle basis, pick these stocks up at a decent discount, and get ideally that gap closing over time. And the final point I'd like to raise on this process slide of ours is that we do keep a mind open for inflection points and changes in strategy or management teams. In fact, the stock I'll talk about in a little bit, one of the examples for a stock we own, the portfolios, has had just that. It's a good business, and there's been a very positive change with the management team that has actually led to a significantly better outcome, we believe, for the company and for investors. And of course, we work in the small and microcap space predominantly, and we think that area is under-researched by the sell side, and the application of research principles and work from the team at Spheria can actually yield significant results for our clients. So to take you through one example of a stock that we think does fit that bill in terms of long-term red pill thinking, it is a stock, Michael Hill, which we've talked about with clients before. Michael Hill, as many of you will know, is a specialty jewelry retailer. It's got operations in Australia, New Zealand, and Canada, with a 40-year plus track record. It's been around for a very long period of time. You can see from the chart on the left there we put up, which is a typical chart that Spheria shows when we're doing presentations. We just reconcile the free cash flow with the EBIT. So we look for how much of that earnings that they report on an accounting basis actually transfers into cash flow. And you can see that 88% on average is a very good reconciliation. So there's a good generative business here of cash. On the right-hand side, you'll see the return on capital metrics, which clearly have been improving. And I'll detail why that isn't the case in a second. But obviously, if earnings are growing on a fairly fixed cost base and a fairly fixed capital base, it's no doubt that your earnings and returns will actually improve over time. So it was a family-run business for a long period of time, and Daniel Bradkin was dropped in as CEO about 2 and a bit years ago. We had experience with Daniel because he was previously with City Chic, or Specialty Fashion as it was at the time, and we thought he was a very fundamentally good operator. He was dropped into Michael Hill, improved a whole bunch of technology in the background, brought in omni-channel retailing, so they now sell on the web as well, which is now starting to become a meaningful part of the revenue stream. Brought in a loyalty program and stopped a high-low pricing model and brought in a much more consistent pricing through the business. And it started to turn around and show dramatically improved results. So much so that even the first half of numbers just reported showed incredibly good returns and earnings growth, despite the fact that something like 20% of their trading days were lost due to COVID lockdowns in Australia. So we think with cash flow coming through the business, it's now going to have something like $75 million of cash at the end of the year. It's a bit higher at the end of the first half, but it does normalize out for the second half of the year. When we bought the stock originally, it was trading on sub 4 times EBIT, and it's now trading on probably around 5 to 6 times EBIT now. So still incredibly cheap stock. Despite the fact the stock has re-rated a bit, we still think there's a lot of opportunity there. It's a good example of us applying what we think is long-term thinking and red pill cash flow dynamics to understanding stock and valuations. How's all that sort of, translated into performance at Spheria? Well, you can see from this next slide here, these are the 3 funds we run domestically: microcap, small cap, and opportunities fund. And I guess I just highlight the last, maybe 6 months of all those funds. And we've actually had a pretty strong period of performance, which I guess we're proud of in a fairly tough marketplace where there's been rotation, a greater focus on cash flows and valuations. All those funds have started to perform well on a relative basis and in some cases an absolute basis as well. And I think what we're proud of as a team is that we've done it. We stuck to our process through some tough times in the marketplace where it was both favouring red pill thinking and blue pill thinking. But over the medium term, the numbers for those funds will compounded at pretty respectable levels and meaningfully above the index, which is ultimately the test of our benchmark. So to conclude, we think that focus on cash flows and valuation will lead to long-term outperformance for investors who are patient. Our view is that central banks and this idea of, they're all powerful, this idea that IZERP or rates will be zero forever is coming to an end, and cost of capital is actually rising. Investors will start to count the cost of cash flow burning companies and start looking for fundamentals again. We suggest not investing in jam tomorrow stories will save you significant pain as an investor. Look for businesses that are making earnings and cash flow today and stick with those fundamentals. And then lastly, we think strong balance sheets remain a very key way to mitigate risk in investing in small companies. Highly geared companies will see interest rates rise, and that will start to put pressure on earnings over time as the cost of debt starts to rise with long-term rates moving up. So with that, I'll conclude and thank you for your time and open up for questions.